Well, good morning or good afternoon for some, and welcome to today's SVDX webinar. My name is Nancy Easterbrook. I am Executive Director of Silicon Valley Directors Exchange, and I'm delighted that you're joining us today. Our topic for today is small cap companies, ins and outs for boards of directors. For those of you who are not familiar with SVDX, I encourage you to go to our website, svdx.org, to see some of our past webinars and sessions, as well as a calendar of future programs. A special note of today's session, I do want to thank one of the members of the SVDX community, Mark Bonney, who actually reached out to me and said, hey, I'd love to see a session on small cap companies, and voila, here we are today. So I do encourage all of you, if you have a topic that you'd like us to consider for a future session, please feel free to reach out to me and we can try and make that happen. Logistics for today, we do have a 1-hour webinar. We will be recording today's session and we'll have it posted on our website at a later date. I'm very pleased to introduce our esteemed panel of speakers today. I will do a short introduction of the 3 panelists. Beatriz Infante is an award-winning public and private company board director and former 4-time CEO. She's currently Chief Executive Officer of Business Acceleration LLC. Ms. Infante has served on the board of directors of various companies and is currently on the boards at PriceSmart, Ribbon Communications, and Liquidity Services. Ken Traub has over 30 years of successful experience as a CEO, senior executive, director, and investor in public and private companies. He is currently managing partner at Delta Value Group, chairman of the board of directors at DPS Group, and a member of the board of directors at Tidewater Marine and Atherseys. Derek Zaba is a partner in the Palo Alto and New York offices of Sidley Austin and co-chairs Sidley's shareholder activism practice. Over the past 2 decades, he has been involved in dozens of activist campaigns and proxy contests in various advisory and principal capacities. Finally, we have a little bit of a cast change, if you will. Our moderator that we were anticipating to have today, Dan Siciliano, unfortunately had an unexpected conflict, and so we are very pleased to welcome Mike Matuzek, who is an entrepreneur and founder of multiple companies. And a really special thank you to Mike for coming in and having the time to help us out today. And with that, we will kick things off. I do want to encourage you to submit your questions. You can send it via chat, or you can send it in the Q&A feature on Zoom. And we are actually going to kick off the session today with a poll. And just give me one moment here, and we will launch it. So the poll is, naturally, given our topic, are you currently on or soon to be on the board of a small cap company? We thought this would be an appropriate first poll so that our panelists will get a feel for our audience as we start to talk a little bit more about some of the challenges that small cap companies face. So we'll just give it one moment while you all are very quick with your fingers. I love it. All right, one more second. And there we go. So it looks like we've got 50% say yes and 42% say no. And that should kind of give our panelists a flavor of who is, oh, sorry, I was sharing results a little bit delayed. There we go, the sharing, 58% yes, 42% no. So with that, I will pass the mic off to Mike, who can kick off today's webinar. Thank you so much.
Awesome. Well, again, thanks everyone for taking the time and super excited to be here. I think as we get started, the goal today is to talk about small caps. One of the things that I think is interesting about this is what exactly defines a small cap. There's a lot of different definitions and a lot of different ways that you can, sort of slice the same apple. So I think for each of our panelists, if they can give us their sort of definition and some criteria for what a small cap is, it'd be a great way to level set to kick things off. Ken, I don't know if you wanted to go first.
Sure, if you want. Well, the traditional definition is $2 billion market cap or less, or between below 300 million, you normally would call a micro cap. So between 300 million and 2 billion is the normal definition. But there are a lot of other factors that could go into it in terms of the revenue, number of employees, age of company. But by and large, market cap defines small cap between 300 million and 2 billion.
And where this comes into play, and that's where it's important to realize that you always haven't always been necessarily a small cap. Sometimes a larger cap company hits some difficult times and then slowly moves down the ranks in terms of becoming a small cap, or sometimes even a micro cap if they've been damaged enough. And where that makes a difference is in terms of succession planning and so on, is that if you've been a larger company, you might have a more mature management team versus a company that's IPO'd 6 months or a year before that has a much younger management team, hasn't had the experience. They both have very serious challenges, but they're different types of challenges. So that's just the one small item to keep in mind.
Yeah, I'd agree with that. I think that there's the metric everybody defaults to is market cap, because you're talking about capitalization. That's how you should define it. But I think for our conversation, it really depends on the company's processes, procedures, internal behaviors, because you can have a $2 billion biotech company with $80 million of revenue. It's very different than a $500 million distribution company with 50,000 employees and just a tiny market cap. And really, for me, the way I think about it is I'm an advisor. I come into companies. You can have a conversation with the board for 10 minutes, management for 10 minutes, and you get a feel for how they operate internally. And in terms of the type of advice and the type of things that might be applicable to them in this conversation, it really is more dependent on those more qualitative procedural type factors than market cap per se.
Very good. Awesome. So I think you should think between small caps and large caps. One of the implications, especially come up a governance, succession or compliance side of that lack of scale. Small caps are certainly in a different position. Their capabilities are very different, and sort of their needs are different as they grow. Derek, I don't know if you want to start off on this one, but what would you say some of the implications due to that lack of scale are for these small caps?
Yeah, let me take one, which is the governance side, and then some of the operations and maybe board processes will defer to the other folks. But certainly the expectations on the governance side are very, very different. And this, I'd say, we can broaden it up to ESG broadly. So governance, environmental, social. You're not held to the same standard as are the big folks. One is you tend to have more governance type defenses. You tend not to draw the shareholder proposals that you might get when you get to be $3, $4, $5 billion. And so some of the things that may be acceptable in small cap land are very much not acceptable for larger companies. I think the thing that people and that's been true for a while. I think the thing that is changing and folks want to talk about these days is ESG, or really ENS, environmental and social types issues, because everybody's talking about it. And it is the case that large companies have teams of people that they can put on these types of issues because they have large staffs. And if you're a small company, you're trying to juggle a lot of things. You may have one or two people in the legal department that are responsible for everything. You can't delegate ESG to one person to kind of to lead up. So I think the important thing to remember for small companies that are in that situation is you're really judging against your peers, right? And especially when you're in a kind of this nascent, the rise of ENS, you really just don't want to be a laggard. You want to be in the pack. If you want to be ahead of the pack, that's a conscious decision you might make. But the one thing that you do want to avoid is making sure you're behind the pack. Because that's the one place where, for smaller companies, investors and others will notice that. Versus if you're in the pack or above, I think that you'll generally get a pass, certainly for the next couple of years.
I think one of the other issues is, and I've been on boards with directors who have only been on large caps or medium cap companies. And they're really surprised. I'm thinking one board in particular, someone who's only been on large caps, and he kept asking for succession plans. And the fact of the matter is, in a number of the smaller companies, there is only one chief counsel and there's nobody else underneath. There is no succession because the company's too small to have more than two people on the legal team. If you're a much larger cap company and you're the CFO, you typically would have a CAO, chief accounting officer as well, someone who could step in and into the shoes if something happened to the CFO in an emergency type situation. But I, as someone who was a CEO, ran somewhere between a small cap and a mid cap, one of those gray area companies. I had a CFO leave in a very sudden situation, and I myself was not a financial person, but there was all of the people in the finance team. There was an expert in FP&A, there was an expert in tax and treasury, and so on, but none of them had the breadth to become an interim CFO. And so I wound up as the CEO meeting with my audit chair on a weekly basis saying, please teach me how to run a finance team. So, it's sometimes hard to really appreciate how thinly staffed the companies are. And some of these requests, again, back to the governance issue of, hey, could we have a succession plan, and do we have sufficient number of people to handle any kind of emergency? You may not have that alternatives, and the implications for boards is you may need to roll up your sleeves a lot more than you might have to in a different type, much larger company, because literally there's no one else like this. My audit chair stepped in and helped me because there was no one else who could help me, become more of a financial expert than I was at the time.
Let me add a little to that. You can make generalizations that small cap companies don't have the same resources as big cap companies, whether it's in the depth in each department of the organization or it's advisors that you bring in. And those are probably fair generalizations. But I'd have to say one of the most memorable anecdotes that I remember from when I went to business school, and as you can look at me, you could tell it was a long time ago, but a professor said, be careful with generalizations because you can drown in a river that averages 1 inch deep. And I liked Beatrice's anecdote because every situation is different. So, we can generalize small cap companies have, smaller departments, less succession plans, maybe more entrepreneurial. But what's fun about this is every company you get involved in, they have unique circumstances. And so I like to avoid the generalizations and focus more specifically on what this company needs, what river they're in, and where in the river I'm diving into it.
Very good. Yeah, no, I think that is so true. Always in so many different cases, it does come down to the nuances of the specific needs. And one sort of quick follow-up on that is before we get into some of the activism stuff, one of the places where I spend a lot of my time right now is sort of in that growth stage, the pre-IPO companies that are really focusing on that late stage ramp. And, a lot of the conversations that we have with their leadership, it's fascinating on how much of this stuff sort of matters to them when they think about actually going public. And this crosses their minds of the decisions. And I think it's something that's not only grown, but I think it's only continuing to grow, almost sort of, I think to your point, Derek, from a scarce side of like, we don't want to be the lagger in this area. You guys, as you think about that from a growth company side, is there any implications on the IPO market or any other sort of antidotes you guys have about, how that sort of new stage of sort of asset class is impacted by a lot of these board discussions?
Well, I think certainly if you've been in a hyper growth environment, you sort of understand what it's like to have to grow, 50, 100% year over year. And what most people underestimate is the amount of time it takes just spent interviewing and hiring, right? Because if you've been growing, pretty well, et cetera, and now all of a sudden you hit that acceleration point, you spend, X number of hours just winnowing down the candidates, et cetera. And if you're trying to, and so it's not just this time spent hiring, but how do you train the guy who used to in R&D be the lead engineer for a 2-person project, and now he or she is managing 10, 15 people, and they have no skills in how to run a team. They don't quite know how to set up schedules, et cetera. So it's really, unless you've been in that hyper growth environment, it's hard to appreciate how difficult it is to get people trained. And some people won't cross the chasm, as Jeff Moore has talked about. They love that early stage environment where it's a free for all and just sort of, text somebody or Slack somebody. And all of a sudden now you've got to coordinate a lot more people and interact with a lot of different people. So that's where understanding not just the technical skills of your team and whatever function they're in, but the social skills of your team. Do you have folks who are aggregators? Do you have folks who cross team lines to coordinate people, et cetera? And understand and not just use, are they good at their job that they used to do? You have to understand their ability to do the job you're asking them to do next.
Yeah.
And that's not always easy, particularly if you're struggling with, how do I do this?
No, absolutely. And so I think if we shift over and we think about the sort of exposure that small caps have to sort of activist investors, it's sort of a fascinating space. I mean, Kohl's is, even from a large cap, what they're dealing with right now in the current market. But, is there any sort of advice you have of what sort of makes small caps enticing to activists? Ken, I think you may have had some additional thoughts on that, but, what is it that makes these companies so enticing?
Sure. So look, I've been involved in activism on all sides. I was a CEO that defended against activists. I have invested as an activist. I've served on about 20 public company boards representing activists. So there are some factors that make small cap companies attractive and some that make it less attractive. Being an activist is expensive, right? It's incremental dollars to spend that add to your investment cost, and it's got to really be worthwhile. So the bigger the target, the more practical it is to spend those dollars. But why do small cap companies attract more activists? Because, well, it's A, easier to build a meaningful position, and B, as we were talking about earlier, there's less systems in place, there's less depth on the bench, and there's often more opportunity to identify improvement. So why does an activist want to get involved? Because they believe, whether they're right or wrong, that there is an opportunity to make changes that will enhance the value of the business that the current board of management has either been unable or unwilling to do. And by spending the time, money, and aggravation to run a proxy contest or negotiate a settlement with the board to bring on new directors, they believe they'll improve the odds of making the changes that are necessary to enhance the value of the business. Now, people can debate whether their motives are sincere or not, but that's why they do it. And it generally is more practical in a small cap company that has weaker defenses and more opportunities for improvement.
Were any of the ones?
And it's also the
good,
opportunity as well, as you said, and as with Ken, I've also been on the defending against attackers and also being nominated by activists to be on other boards and so on. So and I think the thing to keep in mind for small caps is they're frequently, not always, underfollowed in the markets. If you're Microsoft, you're under a lot of scrutiny. Okay, so the opportunities for improvement are fewer. If you're underfollowed, if you have maybe one analyst who follows you and a bunch of shareholders who are sort of institutional, but they kind of, you look like an interesting company, so they got some money in there. There may be a gem there where the a single investor. So, for example, there's different kinds of activists as well. So there's folks who really do their homework, and you've probably heard their names. Folks like Starboard Value and Value Act. Starboard Value does a lot of research on how to improve a company. And sometimes they want massive improvements. At Darden Restaurants, which was not a small cap, they replaced the entire board. At IDT, they added 2 members to the board. I was on a board with a fellow who was on that board, and they doubled, quadrupled the market cap of that company with a very short period of time. So you can have, as an activist, a fairly significant impact if you choose your targets correctly, which is why there are folks who specialize in targeting small caps, folks like Eric Singer's, Viex and Northern Right Capital, Elliott Management. Elliott is all over the place. They do large caps, they do countries, they do small caps, depending on where they see the opportunity. Yeah. But if you're underfollowed, if you think you have greater value in your company than is reflected by the stock, don't be surprised if you become a target for an activist, because those are exactly the kinds of targets that they look for.
Yeah, I think we spent a whole session on small cap versus large cap activism and all the dynamics and all the difference. I mean, it really in my view, it's a very different animal. And I didn't realize this till now, but all three of us have spent time both on the activist side and on defending against him. I was an activist for several years as well. I had a partner at a hedge fund, and I would say that it is just very, very different. And one of the things that strikes me as a big advantage that small companies have relative to large companies, having gone from an activist into the defense world, is large companies take a long time to make decisions, even in these critical crisis situations. So when I was on the activist side, if you wanted to respond with a press release, we could write it in 2 hours and get it out. And small companies can't be quite that nimble, but they're very nimble. For large companies, you're typically planning out several weeks. You have to have every contingency planned. You have to go through layers of management and then the board. So you're kind of limited in your ability to move quickly, and that is a huge advantage if you find yourself in an activist situation against a small activist. To your question specifically, why are they more attractive? Well, I mean, part of the numbers is there's just so many more small companies than there are large companies, right? I mean, there generally is going to be a lot more activism. It takes less dollars to get there. If you want to be an activist against a $50 billion company, there's only like 10 that can actually do it, because there's only 10 that can get the funds to actually go after them. There are hundreds of folks that can get the money to go after a $500 million company. And then the other piece that I think jumps out is one of the core parts of activism that is and always has been a part of the activist repertoire is getting the company sold, which you can do for a $500 million company, you can do for a $2 billion company. There aren't many $50 billion companies you have multiple buyers where you can really demand the sale. So I think for a lot of reasons, it's just a lot different, and I think it does lend itself to more activists. And remember, it only takes one activist, right? There can be 100 people, and 99 could say the company's going well, and one could say I got an idea. It only takes one for an activist to show up, and because there's so many down in the smaller companies, you're just generally going to see a lot more activism.
And a follow-up question I think that's super helpful. Ken, I think maybe specifically to you, how do you think the new universal proxy rule will impact the number of campaigns / proxy contests that will occur this year?
Yeah. Frankly, I think it's overdue and welcome. I think maybe Derek is going to disagree, and this will get interesting. The deck is stacked against activists. It is.
Let's look at interesting. I love it.
But I love it. But I'll give my reasons why, and let Derek give his counterpoints. First, the company sets the rules. It's their bylaws. They schedule the annual meeting. They determine the rules of the road. The activist has to follow those rules. The activist has to spend their own money. The company is spending its money, which is really the shareholders' money, to defend itself. So in a way, an activist that's a major shareholder is spending twice. And the money they're spending is incremental to their investment basis. There's also a stigma against activists. Maybe it's well-deserved. Maybe there's been situations where activists have done more harm than good. Maybe they've acted in their self-interest to the detriment of companies. But there's also times when companies need to be changed, and there's a role for the activists. But in general, in our society, activists are looked down upon. So there's a lot of reasons why the deck is stacked against activists. This step is really a way of helping to level the playing field just a little bit by giving the shareholders a right to be on the same proxy card, because the existing system was cumbersome. It is difficult for shareholders to decide how to vote when they have to pick between two competing cards, the activist card versus the company card. And here, there's the ability to vote on the company's card, and those directors that get the most shareholder votes win. It's much
And
more
that's
democratic.
what the new rule means, right? Just to summarize that, because then maybe it's good for the group to hear that. So that's what the new universal proxy rule is essentially just creating that single card where they can vote on the company card.
That's right.
Yeah,
Yes.
the shareholders can mingle it. Right now, you either have the activist proxy card or the company proxy card. You can't mix and mingle. You can't say, hey, well, I kind of like this one director that the activist proposed, but I don't think the whole board should be replaced, right? If as with Darden Restaurants, you're coming in and saying, we're replacing the whole board, and you think, I kind of want half the board replaced, but not the full one. You don't have that flexibility to have a single proxy card. I'll turn it over to Derek in a moment, because I think the challenge with this is that there's no minimum requirement for length of time or amount of shareholding. So you could have one share, you could be a criminal, you could be on the terrorist watch list, and you could, if you go through all of the hoops, you could put yourself into a proxy contest with the company. And so I think it's going to be interesting to see how that plays out.
Yeah, I think so as well. Let me address some of Ken's things. I think we start out with all the advantages the activists have. And I think a lot of the things he said is true. Certainly companies do set the rules, but I think the activists have a single biggest advantage, which dwarfs everything else, which is they get to pick which companies to go after. And so they get to pick the playing field. And you can, if they don't think they can be successful, they don't have to go there. So whatever the rules are, the rules get easier, they go after 200 instead of 150. If the rules get harder, they go after 100. But whatever the universal set of companies that the activist goes after, they believe they have a path, and the rules are set up so they have a path. And I think the universal proxy is, I don't think we're debating that it is helpful for activists. We sometimes have that debate, and we can have that, but I do think it does in most cases, and I don't want to generalize, otherwise Ken's going to yell at me, but it is true that in most cases, it is easier, and it does make it easier for activists. I concern, and I actually like the old cumbersome system for the following reason, is because when you put an activist director, when they get elected, it's not just another independent director with some skills that you put on the board. Generally speaking, it is viewed that there is some sort of mandate for the activist thesis. And so they bring with them not just who they are, but all of the things that activists is saying. And I like the fact that there was a separate card, so an investor actually had to choose to go onto that card. Now it's not worth debating too much, because that ship has moved, and now we are onto a universal proxy. But that leads me to what I hope to happen. And I will say, when people measure activist success, the question is, did you get one on? Right? Did the activist win or the company win? The measurement is one. And I think that if that is, I hope that is not the same perception that continues in a universal proxy world, because I worry that a lot of investors, particularly the index funds, will use this and say, well, let's just look at all their skill sets. Let's pick the best board based on skills matrix or everything else. And that's fine if at the end of the day, the activist doesn't bring with it this mandate that I think has occurred over the last couple of years. But I worry that people will think they're voting on a set of directors based on skills. And then it will turn into, if any of these activist directors get involved and get in the boardroom, they're going to claim that they have a mandate because they came from the activist side, which I think is less true in a world where people are viewing the universal proxy in that manner, which some investors will. So that's my concern.
No, it sounds like you guys could go back and forth on that for quite a while, but it is fascinating, sort of some of the changes. And so I guess maybe back to the group, or Derek, I think maybe you had some additional insights on this, but strategies for small caps to work with big institutional investors that may not pay a lot of attention to small caps traditionally. Are there some strategies or best practices or things that any of you guys have seen that would be good for the group?
Yeah, I think you get this for smaller companies all the time, because everybody's told you have to go talk to the index funds, you have to talk to these governance teams, they're so important. And the truth is that they're pretty capacity constrained, and it's tough to get your attention. If you're a $3 trillion company, it's very different than if you're a $300 million company to get their attention. But I do think there are things, just from a practical perspective, you can do to help facilitate that engagement and get on their radar screen. And you really want, and goes back to activism or any other crisis the company might have from a voting perspective, is, and I've heard the head of one of the governance institutions at one of the major big three index funds specifically say this: the first time you come talk to me, I don't want it to be with your hand out coming to ask for my vote, right? I mean, that's, you want to have some sort of relationship. They want to have expressed their views and have you a chance to address their views before you come out and you're asking them for their vote. So what are the things that you can do? Well, the things that are more likely to get their attention is if you have some issue, right? If you have an issue which is like a problem, or if you have something where you want to vote or want their input, great opportunities to go out and try to procure a meeting. That's helpful. Bringing a CEO, bringing a director also increases the likelihood that you'll get a meeting. But even if you don't get a meeting, because it is going to be tough, it is helpful to communicate to them on a periodic basis, 6 months, every year, but send them something that speaks to the types of issues that they are worried about, right? Send them an email. If you have a sustainability report, let them know that that's out there. These institutions are very, very good at historical memory. Like they keep records of all these interactions. And even if you can't talk to them, if you have a history of telling them things and talking about the types of things that they care about and demonstrating that these are things that your company is taking seriously, you will get credit for that. They will understand if ever the time comes that there's a crisis that you are trying to move in that direction, and they will understand.
Yep.
You reach out 4 times, we couldn't give you a meeting, but we very much appreciate the information you provided. So I think that there are ways that you can, try to get credit, even if you can't get their attention. And I think you'd be benefit from trying to take steps in this direction in order to try to establish some sort of relationship with these folks.
Any other thoughts?
Not to hark back too much on the previous topic, but one of your best defenses against activists is actually to have shareholders who understand your strategy and who are supportive. And that means that you have to, again, not reach out to them when there's a crisis, but to have communicated what your strategy is and so on. Because frankly, one of the trends we didn't talk about is that not all activism today is only activist shareholders. Lots of longstanding institutional investors who get sufficiently frustrated with a company may either call in an activist or turn activists themselves if they need to. But if you're communicating your strategy, and as one example, I was on a compensation committee and I reached out to shareholders. We had issues before my time with CEO compensation, and there was a new CEO, et cetera. And so we actually reached out to shareholders. We went through the plan and said, look, this is our 3-year roadmap for fixing this problem. We can't fix it overnight. We can't, suddenly reduce people's salary by, 30% and not have everybody quit. And that would be bad for you as shareholders. And so even though it's a very knotty compensation issue, they said, okay, we get it. And we're going to hold you accountable that next year you're going to do what you just told us you're going to do next year, and that the year after you're going to do what you said next year. And we did. And so even though there were some, very troubled, turbulent waters, we managed to navigate them fairly well because the shareholders had understood what we were trying to accomplish and the timetable we were trying to accomplish it on. So keeping open communications, having directors speak directly to shareholders, minus the CEO, because sometimes they're not comfortable telling you, hey, we think the CEO is overpaid, or we don't like the CEO's attitude or something. It is really important, is having that board involvement in addition to the company's obvious communications with shareholders.
I agree. So the engagement with shareholders on an ongoing basis throughout the years is super important. I can't tell you how many boards I've joined where I was told by management that we have a policy that only management can speak to shareholders.
Yep.
And now directors need to be careful when they speak to shareholders. And we have to recognize Reg FD and not go outside of our lane. But there's an important role for directors in communicating with shareholders. And most of those calls can be with management. And if a question comes up that's about the operating performance of the company, it should be handled by management. But there's a reason why either the chairman of the board, chairman of nominating committee, chairman of comp is on these calls to address what could be topics of interest as it relates to executive compensation, director nominations, and shareholders do want to hear from those directors. And as Derek and Beatrice both said, it's not just at annual meeting time. It's, well in advance of that when they're less busy and they want to have a relationship with you and understand what you're doing to govern the company properly.
Yeah. And
I think
there's
that is a evolution where you wouldn't have said that, 10 years ago. And, at some point it may be you have to engage as a director. And I do think there's a difference between large and small cap here, where if you get a large institutional investor that owns a decent stake in a $200 billion company, that's a lot of money. And if they ask to speak with a director, it's very difficult to say no to that, right? And most companies these days that size don't do it. I think the record in smaller companies is mixed, but I do think if somebody wants to talk to a director about executive compensation, about the CEO, about the oversight, about things that are clearly within the board's purview, I mean, you have to think long and hard if you're going to deny that request. I think that is there may be cases in our situations where it makes sense, but you have to understand that would come with consequences in this day and age, because on those types of issues, people expect that real investors should get access to be able to speak to the people where these issues are in their purview.
Yeah, and I think there's a number of follow-up questions on this too that we can get back through and touch through. I think the one other item that we really wanted to sort of get out as a group is just talk through briefly the unique dynamics between board and management relative to larger companies, and strategies to optimize this. I think that is one of the real unique things about a small cap, is that relationship between the board and management. And if you guys could each maybe touch on that, and then we can get back to some of these specific questions following up on the investors and activism.
Well, I think we talked a little bit about the unique challenges of making sure you've got succession plans and so on, and really understanding the scale of companies, and understanding, as Ken said, each company is a unique situation. They may have gone through a huge growth spurt, and now the market has slowed down. So now, or maybe something like COVID has hit, and you have to take employee actions just to get you back to profitability and conserving cash or whatever. So I think understanding that is important. And one of the things that I have found actually was made easier by COVID. As Ken said, some boards have this sort of reluctance to let their directors talk to shareholders. Likewise, I've seen boards have a reluctance to talk about succession planning on the mistaken assumption that if they talk to the CEO about succession, that somehow the CEO will get the idea that the board wants to replace them. And that's not the situation at all. But it's a common misconception. And I think there are fairly easy ways of having the CEO develop a succession plan that frankly with COVID became easier because, hey, if you're sick, what do we do? And so what I typically do is on boards that I'm on, we ask the CEO to put together a written document that says, if you were run over by a truck, and we literally phrase it that way, tomorrow, and you're incapacitated and in the hospital, who would you put, or set of people sometimes, in place to replace you? And most importantly, what does the board need to know about that person or those people in their role as acting CEO, not in their current role? Say you're naming your CFO. Well, we as board members are familiar with the CFO in the CFO role, but in the CEO role as acting, would there be tension, say, with the CTO? Would the CTO want to be acting CEO? Would be there personality conflicts? Would we need to have a director pay extra attention and talk more frequently to the CTO to make sure things are being, smoothly handled, et cetera? So putting it in that context, I think helps CEOs think about it, and also helps the board, because literally if someone is hospitalized and unable to communicate with the board would have to step in and do something. And if don't have the tools to understand what to do without breaking something, you could wind up in a bad situation.
And there's actually a follow-up I think that fits in well with that, and Ken, maybe you jump in on this one, or Derek as well, feel free. But with, the question is, with boards implementing COVID-19 modifications to executive comp programs last year, in 2020. Do you see this continuing this year and beyond?
I can take a stab at that, and
Go ahead.
feel free to jump in. Yeah, I don't think we're seeing it as much. I mean, certainly in 2020, it was just completely unexpected, and people didn't even know what COVID was before that time. And so you saw a lot of changes. I think you are, you are seeing a little bit in 21, but it's not nearly what you saw in 20. And the one thing which probably most of you know, or certainly the person asking this question, is you really have to read the room, because there were in 2020 some modifications, bonuses that were given in an environment where people were losing their jobs and pay getting cut. And I will tell you, the reaction from investors to that was dramatic. I mean, it was like the third rail. Even in situations we were talking about, as just an example, an activist situation, you were talking about putting people on the board. It was completely, the thesis had nothing to do with comp, and a fundamental big investor, that not an index fund, a big investor, portfolio manager, all he wanted to talk about was, how dare you raise, increase the bonuses when all these people were getting fired. So, I mean, this was the type of issue in 2020 that was really, really sensitive. So we are, seeing a little bit, but if you are asking the question because it's something that is, under consideration, I think you just need to be really careful in how this is going to be viewed by the marketplace, because it may not be worth the trouble, given what happened to some of the folks that tried this in 2020.
Yeah. We talked earlier about what may attract an activist. It's hard to think of a better way than rewarding management with bonuses in a year that shareholders suffered. So it really comes across as tone deaf. Shareholders want to trust the board is on their side. And when they see evidence that the board is not aligned with the interests of shareholders, be ready for activists to look for change.
Yeah, and I'll say that it's companies are in a tough position, especially in Silicon Valley, because some of these people might have pre-IPO package that they're getting offers, and it's just hard to retain people in those types of situations. You do, if that is the situation, you really need to message it. You really need to go out and talk about the situation. Like it can come across as tone deaf, but sometimes that's what you need to do for the business. But you just have to make sure that this is something and you communicate it in the right way, and it doesn't look like you're doing this just to, as Ken said, reward management in a year where maybe their bonuses didn't hit because the company was down.
Awesome. Yeah, these questions are coming in. These are great, everyone. Feel free to continue to put them in chat, even if we don't get to them now. We do our best to circle back even afterwards. But another one is, what are some ways to become visible to activist investors as a potential director for one of their slates?
I'll start with that one. In my view, the best way is to tee up ideas. So that everybody is looking for the next idea. And even if the activist doesn't take your idea, the fact that you showed up and said, here's a company, here's my analysis, here's the case for change, and here's why I think that there's a path to executing on that change, they'll get to know you. And they'll get to see how you think. And maybe they'll follow through in that deal. And if they do, they may even reward you for it. But if they don't, then you're on their radar screen as somebody that, that you've proven that you can think like that. There's other ways to do it, of course, and I'll leave it to you guys. But to me, that's the best one. Tee up an idea.
Let me just follow up on that. That's really interesting. And certainly, it's a case that the stigma of being an activist director has gone down over the last 10 years. It's still there, but the types of candidates, they're getting more qualified, competent candidates. They're willing to sit on slates than they were a decade ago, for sure. I'm curious, Ken, just your view on the level of that stigma. If somebody in the audience is thinking about going on an activist slate, how do you view that? How has it changed? What are the things that they should be thinking about if they're thinking about doing that?
I think there still is a stigma. I think that there are some people that will not be willing to do it because it's not consistent with their brand. That if they're on an activist slate, then they are concerned that they will not be perceived as pro-management. I think that's a misconception, and I'm hoping over time that changes more than it has. I do think that there are good activists and bad activists. There's good management and bad management, and the no side has a monopoly on the truth. And I would just encourage people to be selective. This is your life and your career, and there's only so many chances to do it right. So align with good quality investors and target companies where you feel like your presence can really make a difference. And then if you do, I wouldn't worry so much about the perception, because you're doing what you believe in your heart. You can make a difference in helping the company.
But I would caution folks to understand that if you are part of an activist campaign, you are opening yourself up to all sorts of personal attacks. So one situation I was involved in, which was with a not so much an activist, but a regular institutional shareholder who just got fed up with the company. And this was someone who knew me from other boards and reached out to myself and another public company CEO to participate and go on the board. Well, the company, which had a number of issues, defended itself quite vigorously and started flinging accusations, in public email, press releases, and so on that were false. And we weathered it, not an issue, because I believe my track record stands up for itself and so on. But just be aware that, it can get ugly. And if you are bothered by ugly, you probably should not engage, because you don't know how the company's going to react. And they could potentially get very up close and personal. And again, you have to sort of feel like, that's not going to bother me. But if it is, then I'd suggest avoiding.
Yeah, I think there's just a chat on that. So I think there's two ways that you can, I don't join is the right word, but you can be involved with an activist. One is to be on the slate. The second is to be, look, I'm here if there's a settlement. I really don't want to be public, but certainly most of these things settle. And a lot of times companies might want a candidate that wasn't publicly associated with the activist. So certainly that is one way you can do it, that, where there really isn't the stigma. But the other thing I think I see where I don't think activist candidates necessarily give enough thought is, what are your odds of actually getting on the board, right? If an activist puts up 4 people or 6 people, vast majority of the time, not all the people are going to get there. Primarily because most of these things settle, and if the activist is putting up 4, they're going to settle for 2 or something like that. And so when you're thinking through, do I want to be on that slate? Think through who the others are. Are you number 4 and are likely going to be dropped in a settlement? But I think it's something you should really, consider when you agree on a slate is this actually going to be on the board, or I'm just going to be the last person that doesn't get the settled seat?
Awesome. And I think just for time too, there's a couple of quick questions. Maybe we just keep the answers to just a minute, so we maybe get to a couple of these last ones, and then there's sort of a final question we wanted to ask the group. But 2 final questions that were sort of listed here were, this one's for Ken or Derek. As activists, when you wanted to nominate directors, how would you decide nominating independent candidates versus yourself/principals?
Yeah, go ahead, Ken. I can.
It's a good question. So it depends. If as the activist, if you've done a lot of homework and you really have a strong conviction on the change you want to make, and you don't think anyone outside is going to get it as much as you do, then you probably want to be represented directly on the board. But there's significant advantages to having a true independent on the board. And if you're represented directly, then you become an insider and you're restricted in trading. So in most circumstances, it's better for the activist to have somebody that they trust, that they think gets it, that's not part of their firm, that doesn't restrict them.
Yeah, I think there's probably not just independent and activist principal, and there's activist aligned person that they work with in the back, right? So you have somebody that completely got through a search firm that's completely independent, and you have activist principal on the bookends, but there's space in between. And I would say it depends on the situation, but it is going to be more difficult. There's a higher hurdle to get the activist principal on the board. With an individual, if you have a high quality independent, doesn't look like there's ties to the activist that's nominated, there's often what's the harm? It's well, I'm not, even if I think the board is doing the right thing, the company's doing the right thing, maybe they're not. And what's the harm of having one more independent that seems relatively qualified on the board because they weren't sourced by the board, they were clearly sourced by a shareholder? Why not have one or two on the board, right? That's an argument that tends to resonate in a lot of situations. But what's the harm argument doesn't work for an activist principal. Like there is clearly an activist principal on the board. There is risk. Like you don't know, especially as an investor. And so even there are times when it makes sense, but the threshold for convincing other people that it's necessary is higher when you make that nomination.
And for Beatrice, a different question to you. Someone was asking, when you reach out to investors, do you reach out to their portfolio manager or their research analyst or the governance department? I think this is maybe something you had mentioned before.
Frankly, it depends on who will talk to you. But typically, right. You try and establish the relationship with the portfolio manager, and it depends on the size of the fund. So I'm one investor that I worked with a lot in the past. There's three guys, and they're the investors. They're managing a multi-billion-dollar fund, but they do their own research and they support. Other larger firms like BlackRock, you're probably not going to be able to get a chance to talk to them, frankly. So it depends on the investor and how you access it. But typically, your IR department in the company will know who the right contact is, and if they don't, that's actually a red flag for you as a director. That perhaps the IR team in the company is not really doing their job. I think one other point, back to the getting on an activist slate. Keep in mind, most approaches by activists are actually settled minus a proxy battle, right? So one company that I was on the board of that was targeted by Elliott, Elliott nominated, just privately said, hey, place these two guys on your board. We'd like these other two directors gone. And we felt that was the right answer for this company. And it was indeed the right answer for the company. So it doesn't have to be an all or nothing. You get into this vicious battle in the public markets. Most of these are handled, hey, we're unhappy. Maybe there's a 13F filing or whatever, but you then have a conversation and it's settled minus all the expense and the Sturm and Drang of having a public, proxy battle.
Gotcha. I feel like we could do this all day, but this is so helpful. I think as we sort of come to the sort of conclusion and wrap up, everyone who sort of attended this, they're really trying to learn from you guys on what it really takes to be part of a board of a small cap. And so if there was one piece of advice you could leave, all of the participants with, what would that be? Maybe if we just do a roundtable. Ken, I don't know if you want to go first, but what would the single best piece of advice you could leave if you were sitting in front of one of the participants here?
Being on a board of a public small cap it leverages everything you've learned in business school, but it's much more about human behavior, psychology, sociology. It's group dynamics. You come in with ideas, but if you're one of 7 or one of 9 directors, it's about understanding what everybody else is thinking and trying to advance your ideas in a way that you could build consensus that can impact the future direction of the company. So it's not just about business. It's much more about the social dynamic of getting a group to agree on something and moving things forward.
Yeah, I can go next. And my world, I spend 80% to 100% of my time in activism, with the remainder on activism adjacent activities. And I'd say the biggest thing that jumps out to me for if you're on a board and you're in that type of situation is you have to play to your strength. And I mentioned it before, but your ability to move quickly, your ability to be nimble, your ability to be practical and do things, all of these, this is your advantage. This is your advantage versus being in a large cap campaign. I think if you do, unfortunately, find yourself in that place, and the truth is, vast majority of companies are only 2 bad quarters away from drawing an activist. If you do find yourself in that situation, then I think you need to make sure that you don't fall into the trap of wanting to find everything out. You want to stay nimble and play to that strength.
Yeah, basically, the advice I would have is, strap in, because small caps more than others are a real roller coaster because they are smaller. Unless you've got 100% recurring revenue with long-term contracts, type of company, there's going to be potentially variability, potentially quarters that are missed, quarters that are not missed. And so it's just, it requires being nimble, I think, as everyone has said. And the challenge is in both staying nimble while, as the company grows, introducing the required governance processes, et cetera, that you need as you're growing and scaling, but are somewhat antithetical to being a nimble company. And it's an interesting, very, very fascinating balance of two opposing forces. And that's part of what makes the small caps a lot of fun, frankly.
Amazing. Yeah, thank you all so much. And thanks for letting me participate as sort of a last minute stand in here for Dan, but that was super informative and amazing that you guys could dedicate your time. Nancy, I'll toss it back to you on sort of remaining sort of wrap up steps.
Great. Well, thank you so much, everyone, for joining us today. We appreciate your time. Thank you to Mike for your last minute moderating. Many thanks to our panelists for your time and your expertise. We look forward to seeing everybody at our next SBDX webinar. Have a wonderful day, everybody.